Hello and welcome. Shraddha and I here to wrap all the market action for you. Well, it's been another disappointing day of trade for the bulls, considering the fact that the Nifty is back below the mark of 10,000. But, well, we're still hanging around those levels. It's been fairly range bound over the past couple of days. But let's also bring in an expert opinion about the direction of the market. We are in conversation with Pifani Shekhar, and he is looking at the portfolio out there. So, he's fund manager PMS Karvi. Thanks for joining us, Pifani. Let me start off with your opinion on the current levels at which the markets are and what you see for them going ahead.
Excuse me. Currently, one is trading at 20 times current year multiple, assuming a 15% earnings growth. And next year, 20% earnings growth is already baked in. We have not, for the record, we have not achieved 15% earnings growth for the last 7 years.
Yes.
Now, consider a scenario where, compared to the last 7 years, you have lower inflation and hence lower interest rates. Your expectation of earnings growth is higher compared to what it was in 2011, and your valuation of the market is 50% higher than what it was, say, 7 years back. So 7 years back, the market was trading sometime around 13.5, 14 times. Today we are at 20 times, 1 year forward. So if you put all this together, you will very clearly come to a conclusion that there are clearly pockets of overvaluation in the market.
Yes.
It doesn't mean that the market is in a bubble zone. I go back to what happened, say, 7-8 years back. From 2010 to 2014, for a good 3.5-4 years, the Nifty was in a range of 4,800 to 6,000, right? But you had some very, very good multi-baggers coming out of the Nifty. At the same time, a lot of stocks lost 80 to 90% of the market cap and hence eventually went out of the index. The same happened with the broader market. I think, and that is what stock market is all about. That's exactly what bottom-up stock picking is all about. I think a similar scenario will play out now, where the index will actually present you a very deceptive picture.
Right.
It will present you a picture of calm, whereas there will be a lot of churn and volatility in underlying portfolios.
Absolutely, yes.
So, if you do not have the right stocks, then I think the next 1 year to next 3 years might be very difficult for you, and vice versa is also true. If you are in the right stocks, you will make a lot of money. But looking at the Nifty and making an impression of the asset class will be very, very challenging for the next 1 to 3 years.
Let's just take a quick look at the Nifty index movers today before we ask more questions to Funny. It was the oil marketing companies and Dr. Reddy's which were dragging the index lower. The Realty and PSU Bank index were also seeing a sharp correction of 4 and 2% respectively. So State Bank of India shares were trading significantly lower, the knock of 2% there. But on the contrary, metal stocks were countering that weakness which was seen in the broader markets today. Vedanta up as much as 3.5%. Hindalco and Tata Steel, of course, Tata Steel on the back of its numbers, and Hindalco also, Novelis posted a strong set of numbers. We were seeing some earnings related optimism being reflected in the metal stocks. That apart, Bajaj Auto also saw gains of nearly 1% after its partnership with Britain's Triumph to make mid-capacity motorcycles in India. Funny, do you believe the strength in the base metal prices, which was mainly due to the steps taken by China, is really here to stay? And how are some of the frontline metal companies looking in terms of valuations? Do you like anything there?
Well, I have not bought commodities for the last 10 years. Okay?
Wow.
Thankfully for me and my investors. The way I look at base metals right now is the immediate provocation for these stocks to go up was better than expected Tata Steel results,
yes,
especially the Indian results part of it. Now, Chinese metal prices going up is some sort of a contradiction, because while global demand might go up primarily in US followed by Europe and maybe Japan, it's very unlikely that Chinese demand goes up, because of which base metal prices go up, because we all know that China has close to 25 to 30% over capacity.
Right.
So I don't think that even if global demand goes up, you will have the Chinese overcapacity problem really allow the base metal prices to go up. Of course, if there are certain trade issues between US and China, because of which So for a certain period of time, if metal prices go up, that's a very different issue. But I don't think, and by the way, we should not forget that the Indian metal prices are buffeted by import tariffs that the government has levied. So they are not free floating. So I don't think the China overcapacity problem is going anywhere, and that is something that one should remember, especially when taking a longer term position. But considering that they have beaten down maybe another 10-15%, they're also highly levered.
Right.
Another 10-15% in most of these stocks looks pretty likely.
Honey, for the longest time, and a lot of people out there have preferred private sector banks as against public sector. But recently, we've had this trend of public sector banks starting to cut their savings rates, which may have an implication on its net interest margins. That is an improvement. Is there space for public sector banks to move up in comparison to private sector banks? How would you play this entire sector as a whole?
Well, that's a very interesting question, because so while cutting the savings rate gives them is a big advantage on their interest costs, but we should also ask the question that can this be a strategy? Can they really hold on to their customer in the changing banking environment where technology is playing a key role, and all things all things being equal, public sector banks are not really the fastest and the swiftest employers of technology. So in that scenario, cutting savings rate might actually have the opposite effect of driving their stickiest customers into the lap of private banks.
Right.
So that is something that I would worry about. Besides that, a 50 basis points tinkering on the savings rate is not really going to help you when you have credit costs which are in double digits, if you consider restructured assets plus the gross non-performing assets. So I think they have to come up with something better. Immediately what they need is capital infusion, and you've already seen certain banks working on it. So they have been selling their non-core investments, etc. That's a good beginning, but eventually they will all need capital and a better story to tell the investors, because this time round investors will rightfully ask the question that every 10 years, if you look at the history of public sector banks, every 10 years they have gone through this crisis. The last time it was in early 2000s. So what will change come 2026 or 2027, right? So they need a better story to tell the investors.
So funny then, within private sector banks also, would you really place your bets on names like HDFC, Kotak, Indusin, which have been growing well, have a solid retail franchise, or are building one, or then your corporate heavy book lenders like Axis and ICICI, where there could be some sort of an alpha due to the valuation gap?
Well, if you want steady returns, then the first set, which is primarily the retail focused banks, which have lower credit costs, very high quality retail franchise, well governed. Of course, all of them are well governed. That's something that you would choose if you were a more conservative investor. However, you're right, if you want that additional alpha, then you can go to some of these banks, provided that you actually believe that in the next 2 to 3 years the situation on the investment side is really going to improve. The biggest advantage, while if you look at the asset quality of an ICICI or an Axis, and that's comparable to a State Bank of India, by the way, the biggest difference between these two is the ability of the private sector banks to really raise capital freely, something which an SBI can't do on the equity side. Not because investors don't want to put money in SBI, but because the government will not allow its shareholding to go below 55%. I think that's what will make the final difference.
Right. Okay, so let's also take a look at what's happening in the mid-cap space right now. Considering the market breadth, at least as far as the Nifty 500 is concerned, it's again negative this time. We're looking at just about one gainer for four losers. And in terms of some of these big movers, in gains we have PC Jeweler, Dilip Bilkon, and Igarashi Motors, and Jubilant Foodworks, all for different reasons. Jubilant Foodworks management has suggested that they are going to bring in more products, Igarashi Motor, on account of the fact that they will be supplying materials and perhaps equipment to Tesla. And of course, Mangalore Refinery, Century Textiles. Century Textiles also reacting to earnings. Let's take a look at some of the losers. Weakness in HTI, JBF Industries, Jagarash Associates, Unitech, and DLF, and with DBPLT also bedding down in today's day of trade. But that's as far as the realty sector is concerned. Funny, we are looking at a lot of potential consolidation in the oil and gas space, particularly the public companies. The first question is this beneficial for minority shareholders? For example, ONGC. And what would that mean for something like a Reliance Industries? And of course, then telecommunications is a different ballgame.
Sure. So, whatever I have seen of the ONGC HPCL story, I haven't really understood the strategy behind the consolidation. Because either you consolidate into one large entity, which has absolute power on capital budgeting. If you keep two separate entities, then you are at one level, you are sending conflicting signals. Because minority shareholders who would wish to participate in the oil refining, oil retailing space would ideally like to choose an HPCL. But if the capital budgeting decisions are being taken by ONGC, right, it's better that HPCL actually becomes part of ONGC instead of ONGC calling shots at HPCL. And at the same time, you're also told that these will operate as two independent entities. Then where is the synergy? So there are a lot of questions. Maybe I have not done my homework thoroughly, but these are questions to which I haven't found answers, and hence I will have my reservations on what synergies are being actually aimed at, and whether this is the right way to go about it. Coming down to Reliance, I think the story in Reliance is telecommunications, right, left and center. That has triggered this entire rediscovery of the stock in a way. Stock is up almost 65-70% over the last year or so. It was sedate for almost 6-7 years.
Yes.
But I would still be excited more by Reliance core business compared to the telecom business. Telecom business is still some years away from profitability. And accounting profits are always different from economic profits.
Right.
So it is still further away from economic profits. And once they come, by the way, the incumbents had just started delivering economic profits before Jio happened. So for the entire telecom sector as such, I think another 3 to 5 years is what it will take for investors to get a sense of what economic profits are possible. Till such time, I think consumers will have a good time.
Funny, before we let you go, this is the last question. Any advice for retail investors who are looking to make fresh equity investments? Do you think this is a good level to enter, or they should wait for at least some kind of correction? Will there be an opportunity to buy later?
Well, I'm not a great believer in timing. So the simple advice is, if you have systematic investments running, please continue. Don't be scared by the corrections. Don't be excited by calls of market going to ever higher levels. Markets will eventually keep moving higher, right? So all kinds of possible higher levels are possible. It's just a matter of time. At the same time, considering the frenzy in the market, it's not a very good idea to commit a lump sum into the market at this point in time. So SIPs can continue. For lump sum, please wait for better market levels.
All right. So continue to stay invested in private sector banks and wait before you can make lump sum investments. There could be some scope to enter at lower levels is advice coming in from Funny Shekhar. But that brings us to an end of this edition. Thank you for watching and continue to stay tuned into Bloomberg Quint. We will bring you more on earnings.